Once again, Raymond Arroyo.
Welcome back to The World Over Live. One challenge all of us face: where should we be investing our money? And is there a better time to invest? Many of you sent in questions, so we brought in somebody qualified to answer all of them. He's the portfolio manager, founder, and chairman of the Ave Maria Mutual Funds and Schwartz Investment Council, George Schwartz. Here's our conversation. George, a lot of people try to time the market. They're trying to figure out when to get in, when to get out, when's a good time. Is that a good idea?
No, it's not, Raymond. It's a fool's errand, really. In the long run, stocks go up. In the short run, they bounce all over the place. But buying good, high-quality companies and staying with them, as Warren Buffett preaches, is really the way to do it.
What is your vision, long-term and short-term, of the market as we see it now?
I think the market has tremendous upside potential over the next 2 to 3 years. And people get scared because the market's gone up, basically tripled since March of
it's through the roof.
Yeah, but and people say, well, gee, that's Obama must be doing a pretty good job. And I say, no, the market's gone up despite Obama. Obama has done everything he can, in my view, to retard economic growth and the growth of profitable capitalism, which helps everybody. It helps the poor, it creates jobs, creates prosperity, and creates corporate profits and dividends for shareholders. But trying to do it on a short-term basis or outguess the near-term swings in the market is rather silly. I always say, if anybody tells you they can outguess the short-term moves in the stock market, they're very naive, or they think you are.
One of the two, right?
One of the two.
How can investors capitalize, if you will, on the long-term prospects for the market that you talk about? You say in the next 2 or 3 years it could explode. What should investors do?
The great Sir John Templeton, the late Sir John Templeton, used to say, any day is a good enough day to buy a good enough stock or a good enough mutual fund. And I agree with that 100%. We, of course, manage the Ave Maria Mutual Funds, which I think are very good mutual funds. And John Templeton used to also say, the best time to invest in a good mutual fund is when you have the money. And
it's a good principle.
Yeah, and don't try to hold back and say, well, I'm going to buy on the dip, and I'm going to buy when the market pulls back, or gee, the market looks a little high, I better wait. If you buy a good enough mutual fund or a good enough stock, you can ride with it, and you'll do very well over time.
We've gotten a lot of emails from people who have particular questions, and I want to get to those. But I want to ask some of the macro questions here. What is the right mix for an investor between stocks and bonds? Those things don't always thrive in the same marketplace.
No. Diversification is crucial to a long-term successful investment program. Historically, most advisors have said 70-30, 70% stocks, 30% bonds. But there's nothing magic about that. It's a good ratio, it's a good asset allocation as any, and I would say typically as a person gets older, they should have more in bonds and less in stocks. If they're very young, they can have more in stocks, more than 70%, 80%, 90%. There's nothing wrong with that. And so it depends on a person's investment objectives and their risk tolerance levels and their age. I
spoke to a finance guy a few weeks ago, a big name in New York. He offered this breakdown. I want to run this by you. 30% stocks, S&P 500 index or index, 15% immediate bonds, 5 to 10-year treasuries, intermediate rather, 40% long-term bonds, 7.5% in gold, and 7.5% in commodities.
Yeah. Well, that's overly cute in my view. I would not own any long-term bonds today.
Why not?
Because interest rates are going to go up, and probably sooner than most people expect. Maybe even sooner than Janet Yellen expects. Because she may end up chasing the market rather than leading the market. Inflation will be back, even though there's no inflation today. But 4 years or 5 years of extraordinary accommodative monetary policy, in other words, zero interest rates, is going to have ramifications, and I think it's going to be higher interest rates, maybe significantly higher. But that doesn't mean it's a doomsday for the stock market either. Right. If the economy continues to grow, which I expect it to, and corporate profits continue to grow, dividends continue to increase, the stock market can do very well even in a period of rising rates.
Janet,
bonds won't. Bonds, the long bonds will get crushed.
Janet Yellen, who is the Fed chairman, has said, look,
we're not going to raise rates. That seems to be what she's indicating now. How does someone profit off of that information?
Probably by ignoring it. Because when interest rates rise, it'll be a reflection of the economy doing better and inflation expectations picking up.
But your bonds are crushed.
The long-term bonds will go down in price. The short maturity bonds, like the bonds in our Ave Maria bond fund, will do fine because they're 3-year maturities and less.
What about munis?
Munis are great for high-income people, and they're attractively priced today. I would not buy the long munis, though. You know, the interest on the munis are tax-free, of course. And high quality is crucial. You know, AAAs, AAs only, and short maturities.
What does that mean? A year, 2 years?
Up to 4 or 5 years.
Let's talk for a moment about stocks, which sank on just a week ago on Wednesday. It went for across 9 of the 10 sectors. There was a dip in stocks all across the S&P. What does this tell you? And why are you so bullish given the drop in wages? We have stagnant wages. Corporate rates are going up. Stock market's going up. But the wages are stagnant. Isn't that an incongruity?
Well, first of all, no one should worry about 1 or 2 days movement in the stock market. It doesn't mean anything. It's only the long term that matters. And as far as wages being stagnant, yes, they have been. And it's unfortunate. The middle class has done very poorly in the last 4 or 5 years. The investor class has done well. But I'm anticipating the economy and stocks particularly doing quite well over the next 2 to 3 years. As we get closer and closer to the day Obama leaves office, investors will be focusing on the likelihood that Obama's socialism and over-regulation of the economy will diminish or go away. And it doesn't even have to be a Republican president. If we get a Republican president in 2016, it'll be Katie bar the door, in my view. But even
President Hillary?
Even Hillary will be better than Obama by a long shot. Nobody could be worse than Obama, in my opinion, besides being the most pro-abortion president.
Why? The stock market is charging ahead, George.
But not because of him, despite him. If it wasn't for him having the government foot on the neck of capitalism, we would be at a much higher level, in my view, in terms of the stock market. Much higher.
Okay, let's talk for a moment about analysts. In December, analysts projected an 8.6% increase in corporate earnings in the first quarter of 2015. Now, the latest projection, they are predicting earnings will shrink by 2.6%. Doesn't that concern you as an investor?
It does, and I wish the economy could grow faster. The economy has been growing at a 1.5%, 2% rate for the last 5 or 6 years. Most post-World War II recoveries have resulted in 4 or 5 or 6% annual growth in real gross domestic product. So this has been a pitiful recovery. In my view, it's largely because of the tax policies, the fiscal policy of the Obama administration, and the unbelievable regulations, including Sarbanes-Oxley, including Dodd-Frank. Including the very heavy regulation of the financial services industry, which I'm a part of. But the end at the light of the tunnel is going to be visible pretty soon, and I think things could get a lot better.
Let's talk about your work. You have George Schwartz Investment Group, consultant group, and within Schwartz Investment Council is the Ave Maria Fund.
Right.
Why did you find the Ave Maria Fund?
My good friend Tom Monahan came to me about 12 years ago with his friend Bowie Kuhn. You knew Bowie well, I know, the former commissioner of Major League Baseball. And these two Catholic men, clients of mine, said, George, why don't you start a Catholic mutual fund? And I think I've told you this before, Raymond, but I said, well, that's fine. What is a Catholic mutual fund? You want me to invest in companies that make Bibles or rosaries or build churches? What are you thinking? And they said, no, just invest the way you always do, George, you and your staff of analysts and portfolio managers. Invest in high-quality companies, but screen out companies that support abortion and pornography. So we did that, and we put together this Catholic Advisory Board, which today includes Cardinal Maida, retired Archbishop of Detroit, as well as Lou Holtz and my friend Larry Kudlow and the great Phyllis Schlafly and several other prominent Catholics. And so they set the standards for what we should screen out.
Are those the only two things you screen for, pornography and abortion?
Abortion's the big one, and also companies engaged in embryonic stem cell research, which is closely related to abortion, and also companies that contribute to Planned Parenthood.
How far do you get into the weeds there? I mean, because look, you've got hotel chains that are solid companies, but they have SpectraVision or whatever the in-house cable offerings. They're out.
Yeah. We have 3 or 4 different screening services, commercially available screening services that we rely on, and our Catholic Advisory Board has said these are the services we should use to screen out companies. And sure, the hotel companies that show pornography on their TV screens, they're out. Sure.
You call Ave Maria morally responsible investing. Is it also good, solid dollars and cents investing? Do you turn a profit?
Oh, absolutely. Yeah. Our long-term track record is excellent. And our two leading funds have actually produced returns of 15% compounded annually for the last 3 years. And we're very proud of that. And we are not what some people call socially responsible investors.
What's the difference?
Socially responsible investors are screening out different things, oftentimes environmental related issues. So-called social justice matters are considered. Also income inequality, or they want to invest in companies that produce affordable housing and so forth. Our screens are the ones I mentioned, and
morally objectionable.
Morally objectionable, yeah. One of our
things you want to cut out of your investment.
One of our Catholic Advisory Board members said, George, just screen out the mortal sins. Don't worry about the venial sins.
That's
a joke.
That's pretty good. I want to run something by you the Pope said at the top of the month. He said money is the devil's dung. Now, he was comparing money to an idol and said that it can destroy man. You would say what?
I think the Holy Father is a very holy man, and I have great respect for him, but I don't think he understands very well the benefits of capitalism. And capitalism has, as you know, Raymond, lifted literally hundreds of millions of people out of poverty, created jobs, created prosperity, created wealth, and it's a wonderful thing, the best economic system ever devised, and I hope the Pope has enough people around him that can advise him and remind him of those facts of the benefits of capitalism.
Well, I want to go through some emails now. We've gotten tons of these, people wanting investment advice, so we're going to throw some zingers at you here. You ready?
Sure.
Janet from Bethesda, Maryland asks, we're 57 and 59 and just trying to invest. How much should we put in bonds and how much in stocks? Now, there's that old equation I've seen where you deduct from 100.
Yeah, oh yeah.
Your age from 100, and that's what you should put in stocks. What would you say to Janet?
There's nothing wrong with that. As I said earlier, a lot depends on your temperament, your risk tolerance levels, and your age. So someone their age in their late 50s, what they should do is go talk to their financial advisor, personal financial advisor. If they want to get information on our funds, of course, they can go to our website, AveMariaFunds.com, or call our toll-free number, 866 Ave Maria, and our people can get the historical information and the background information on all our funds. But there's no secret formula, but someone that age should definitely have investments in the stock market.
Rod from Houston, Texas writes, I really am not a person who enjoys the market or watching stocks tick up and down, though I know I should be invested in the market. What's the best way for someone like me to proceed? An index fund, a mutual fund? What's the difference?
It's hard to go wrong with an index fund for someone that has no interest or no sophistication with respect to the market. The index funds are low-cost funds, and you'll ride along with whatever the market does. Not everyone has the temperament for the stock investing either. Some people should be in just bank accounts and CDs and so forth, which produce almost no yield today.
No, not today. You get nothing.
But they don't go down anyways. You can't lose money on
them. You're losing money over time because of
taxes and inflation.
Taxes and inflation.
Sure.
You're losing money. So the question. So you would suggest an index fund?
An index fund if someone wants to have nothing to do with the stock market other than making one investment, and then just leave it there.
Yeah, Warren Buffett said something similar, that if he were to die, he'd tell his wife, invest it in a mutual fund and leave it. You'd be fine.
He's a pretty smart guy.
Yeah, I'll say. Susan from Baton Rouge writes, people keep telling me I should be a compound investor. What does that even mean?
Well, compounding is a great miracle. This is a true story. Einstein was asked one time, what's man's greatest achievement? And he said, compound interest.
Ah.
And the power of compounding is almost unbelievable, especially if you go over a 20-year period, a 30-year period. Even a fairly low rate of return, like 6 or 7%, compounded over many years, gets to an unbelievably big number.
So explain the concept here. What is compound investing?
It's interest on the interest. Mm-hmm. Or if you start off with $100 and you get 6% interest on it, or appreciation, you got $106. The next year, if you get another 6%, it's not going to be just another $6. It's going to be more like $7 of addition. Then you're at 113, and the year after that, 6% is going to get you, past 120. It's compound interest is the power of compounding, as opposed to simple interest.
And then there's the other concept where you take a portion or all of your profits and you plow it back into the investment.
Yeah, that's reinvest your dividends and capital gains distributions. Mm-hmm. Yeah, very wise, especially if you don't need the money for living expenses.
Right, and that's also a good way, particularly if it's in a retirement account that's tax-free or tax-deferred.
Tax-deferred, yeah.
It's a better place to have it.
Absolutely.
If you're interested in finding out more about George Schwartz and morally responsible investing, visit AveMariaFunds.com or give him a call at 866-AVE-MARIA.